It is the final hour of trading, and the numbers have been pretty grim, dismal throughout the course of the day. If you look at the Dow in the last hour, you'll see, although we are off the lows of the day, we're not huge. I think the lowest point was down about just over 315 or 317 points. This was down just around 2 o'clock, and it's similarly at 1:30. Now, we are in that part of the day where you watch very closely as market makers and investors decide how they want to go into the overnight. Do they want to remain long? Are they shorting out? And that's what you're going to see over the next hour. So we could expect to see volatility because the nature of the day has been extremely volatile, coming up slightly down 246. NASDAQ is the worst of the US markets at the moment. The tech and communications index fallen very sharply. This is the global scenario at the moment. And if you see the way the day has moved, obviously we start in Asia and we have some heavy losses in Hong Kong with the Hang Seng. You then have Europe, which has the FTSE off 1.5%, and also Paris down 1.5%. And then you end up in New York and you see the NASDAQ down the best part of 2%. And the reason, well, if you factor down this to its raw potential, it's the sell-off starts perversely. Ironically, all of this starts with positive economic news in the United States, specifically private payrolls, jobless claims, and new jobs in the service sector. That is the job expectations leading into tomorrow's morning's jobs report, that the jobs picture in the United States is pretty good at the moment. Now, that leads the Fed chairman, Jerome Powell, to make various comments suggesting that rates will continue to go up at the short end, and that leads to rate rises. As the official rates rise, so the market rates rise, and there's an expectation of increased rates across the board. So you get the US 10-year hitting the highest level. The bond yields, official rates rise, bond yields follow. We now have bond yields at the highest rate since 2011. And all in all, it raises borrowing costs. Because what happens is, as bond yields go up, stocks usually go down, and you end up in a tussle for yield. Take a look at that. That's what's going on. That is exactly what is happening at the moment in the markets. And that is what is leading to a Dow and a US market down some 1 or 2%. Jay Bryson is with me, Wells Fargo interim chief economist. Good to see you, sir. Thank you very much indeed.
Thanks.
I mean, ignoring the fact that the rate rises is perversely because of good economic news, the markets are finding it now somewhat difficult to take in its stride.
Well, yeah, markets are always kind of forward-looking, especially the stock market here. And so, as you kind of just described, what's happening is you're getting this very positive economic news out of the United States, and that leads investors to think, oh, there's going to be more Fed tightening coming down the line. And so as the stock market starts to digest that and watch bond yields starts to back up, they're looking into the future and they're saying, okay, so if the Fed is really kind of tightening here, maybe that causes growth to slow as we kind of go forward. So, the point here is things right now are very, very strong, but the market is always kind of forward-looking and is trying to discount how much potential slowing we're going to have further out.
Is this rotation or is this downward draft on the market because of expectation of lower corporate profits in the future on the back of a slowing economy, or are we seeing it just a straightforward rotation for better yield, better return?
Well, Richard, I think it's like many things, it's probably a little bit of both, in the sense that, as bond yields go up, everything else equal, they become a little bit more attractive relative to stocks, which are a little bit more riskier. So you do have that going on, that rotation into something that's going to be higher yielding. On the other hand, though, if things do slow down enough because the Fed is getting, a little bit more aggressive in terms of tightening, that could also weigh on profitability. So again, it's a little bit of both, I think.
Have a listen to Jim O'Neill, Lord O'Neill, former head of Goldman Sachs Asset Management and chief economist. Have a listen to what he said about the dollar. I want to get your thoughts.
That I think is strategically wrong is that the role of the dollar is now still the same as it probably was 30 years ago, despite the fact the US economy is nowhere near as important for the world as it was. And so what happens because of the integration of the financial system, Fed start tightening, bond yields start rising, and here we go yet again with this sort of interplay with many so-called emerging markets around the world. And
do you accept that that is the scenario we are in, particularly emerging markets being hit on the back of what is an excellent economic position and a very strong dollar?
Well, yeah, I mean, so what we are seeing is obviously yields in the United States are going up. You know, these bond markets are very highly correlated. So you're seeing yields in Europe going up as well. And even they're ticking up a little bit in Japan. And so you have what's a relatively safe asset, a 10-year treasury bond, the yields going up, you know, the attractiveness that's going up. And then you have these higher yielding but higher riskier sort of places like the emerging world. So when you do see sell-offs in the bond market, when you see higher yields here in the United States, everything else equal, that does cause people to try to, you know, to flee some of those riskier sort of assets. You know, markets will eventually calm down, but as long as the bond yields here are rising and rising sharply, you're probably going to continue to see emerging markets sell off as well.
And finally, these elevated levels of 26,000, the numbers look quite horrific. You know, Dow off 200 or 300 points. It looks quite a large number. But we are at much higher levels. What do you think it takes to calm things down, to have a period of stability, if such that there could be?
Well, you know, I think what it's going to take is just, you know, continued signs that the U.S. economy is not overheating here, right? You know, I think what it really takes is if you look going forward, we see inflation numbers continuing to come in at, you know, moderate sort of levels, that, you know, inflation's not really kicking up, that the Fed doesn't have to over-tighten. At that point, I mean, it's almost like a Goldilocks sort of thing. You have strong growth, but you have low inflation. That's a great scenario. And so I think, you know, as we go forward, we really need to look to see what's happening to the wage numbers and see what's happening to the CPI numbers as well.
Good to see you, sir. Thank you. Great to have you on the program. Look forward to it in the future. Joining us from Wells Fargo's